the fair value gap. And for a good reason, it's incredibly effective. But not all fair value gaps are equal. Some gaps can lead to successful trades, while others might not work out at all. For example, this fair value gap didn't lead to a successful trade, while this one was successful. So what's the secret? Why does one fair value gap succeed while another falls flat? I have a special technique that helps me quickly determine when a fair value gap is valid. By adding this technique into your trading strategy, you'll notice a significant improvement in the accuracy of your fair value gap analysis. Let's break it down in a way that's simple, clear, and actionable, so you can start using fair value gaps to boost your trading accuracy. Stick with me, and I'll show you how. Before we get into that, let's break down what a fair value gap actually is. You can have two types: bullish and bearish fair value gaps. In simple terms, a fair value gap forms when price moves rapidly in one direction, leaving an imbalance. This happens because the price moves so fast that the opposing side, buyers or sellers, doesn't have enough time to respond, leaving a gap in the market. Sellers or buyers often want to return to this zone to rebalance the market. To spot a fair value gap, look for a large, fast-moving candle and mark from the top wick before the move to the bottom wick after the move. This zone is your fair value gap. If you study your chart, you'll notice these gaps all over. And here's the kicker: price often comes back to this zone, fills the gap, and then reverses, which can set up a great opportunity to profit. But if you've ever traded fair value gaps before, you've probably noticed they don't always play out the way you expect. That's because not all of them are valid. So how do you know when a fair value gap is truly worth trading? There are 6 key rules to follow to make sure you're working with a valid fair value gap. First, the fair value gap must be untested. This means the price cannot have returned to the gap and tested it right after it was formed. If the price comes back to the gap after testing it the first time, it's no longer valid. For a fair value gap to be tradable, it needs to stay untouched until the price revisits it much later and just once. Next, pay attention to how the candles behave when they enter the fair value gap. A valid fair value gap needs the candle to close either inside the gap or in the direction of the gap. If the price pushes through the gap but the candle closes below it, the gap is invalid. Ideally, you want the candle to close within the gap, giving you a safer entry. It's okay if the wick touches outside the gap as long as the body of the candle finishes inside or in the right direction. The third thing to look for is additional confirmations like support and resistance levels. For example, let's say you spot a bullish fair value gap. If you also notice a strong support level around the same area, that's a great confirmation. This increases the chances that the fair value gap will hold and give you a solid trade. The same goes for bearish gaps. If there's a resistance level aligning with the fair value gap, that's a sign of strength. By keeping these simple rules in mind, you can filter out the weaker fair value gaps and focus only on the ones with high potential. With practice, this method will help you recognize the fair value gaps that are most likely to give you consistent results. Fourth step, to identify which fair value gaps to focus on, look closely at their positions on the chart. Generally, the lower the gap, the stronger it is. For example, in a chart with multiple bullish gaps, the lowest gap has the highest priority. Conversely, the highest bullish gap tends to be the weakest. Aim to trade the lowest gaps for better outcomes. For bearish gaps, the same principle applies. The highest gap is the strongest. This strategy helps you zero in on the most promising opportunities. 5. Utilizing the Gann box tool. This method combines with the fourth method. Here's how to use it effectively. Open TradingView and select the Gann box tool. Adjust the settings to include price levels 0, 0.5, and 1. This setup gives you a clear visual aid. When you have several fair value gaps on a chart, use the Gann box to draw from the low of the move to the high of the move. This will help you identify which gaps to target. Ideally, only trade gaps in the lower part of the tool for bullish trades. For shorts, mark from the high of the move to the low of the move, focusing on gaps in the upper section. By following this step, you can ensure you're trading only the most promising fair value gaps. The sixth and final step, the importance of breaks in structure. Now let's discuss an essential factor in trading fair value gaps, breaks in structure. A break in structure occurs when the price surpasses a previous high or low. For a bullish fair value gap to be valid, a break in structure occurs when the price surpasses a previous high or low. For a bullish fair value gap to be valid, the price should break the previous high while creating the gap. For example, if the price creates a gap but doesn't break the prior high, that gap isn't worth trading. Instead, look for bullish gaps that coincide with a break above previous highs, and for bearish gaps, ensure there's a break below previous lows. When you combine these steps, you'll have a solid approach to identifying effective fair value gaps. Here's how to apply it in a real trading scenario. Identify the break. First, observe where the price made a high point. This becomes your break of structure. Wait for a gap. After the break, look for a fair value gap to form. Check for validity. Ensure the gap hasn't been touched before, confirming it's unmitigated. Mark priorities, identify which gaps are the highest and lowest priority using the GAN box. Trade with confidence, focus on the valid gaps, and wait for the price to retrace to that zone. Ensure the candle closes within or above this zone, signaling respect for the gap. Once all criteria are met, set your take profit at the high of the move and your stop loss at the low of the gap candle. If done right,